let's turn to our portfolios, and let's talk about, I think, before we talk about what we've done in the last sort of 3, 4, 5 months, because we've done a few things, and I'll hand it over to you, JP, to talk about that briefly in a minute. But I think 2024 is that year that, you know, if equity markets are going to fall apart to some extent, it'll probably be this year. I think a lot of us and a lot of others expected it to happen in 2023, but everything proved a bit more resilient. It took longer for some of the problems out there that could lead to an equity market rout to flow through. So I think 2024 is going to be that year, where it's sort of, if it's going to happen, it's probably going to happen this year. And, you know, that's one of the difficult parts of trying to be tactical with a portfolio. Getting out's probably easier than getting back in a sense, you know. So that's going to be quite a challenging ride for us this year that we look forward to managing. But JP, do you want to talk us through some of the changes we've made over the last sort of 3 or 4 months?
Yeah, I think the key change was in the tactical portfolios, where the team basically closed or reduced some of the underweight to equities. You might all recall we actually had very sharp declines in equity markets from about July down to those lows in October, and the market had become very, very oversold. If you look back at the charts and you look at any technical measure, the markets were very oversold. We're kind of forgotten how sharp that sell-off was. It was about a 12% decline, in fact, in the S&P 500, and the team at Lifespan took advantage of that and actually reduced the tactical underweight to equities in the portfolios, and that's been quite a beneficial move.
Yeah. So we did that. We probably went from being about 80% underweight down to about 60% underweight. So we just topped up our equity positions in the tactical side of the portfolios, and the idea of that is to slowly get back in. I mean, markets did fall quite sharply, but they didn't fall all that much. It was just sort of a very quick drop. So we thought, and our medium and long term, our medium term view is still a bearish one. That's why we didn't, in a sense, buy more. But yeah, we took that opportunity, which has worked out okay. And we also shaved a little bit off our bond overweight, our duration overweight in the tactical portfolios. That's something we actually did in the last couple of weeks, given that, you know, long-term bond yields spiked or went up quite dramatically, and they had quite a dramatic fall as well. I think the 10-year bond went from 5% in the US to just under 4%, which is quite an extraordinary move. But we're still pretty optimistic on longer dated bonds because I think medium and longer term rates are going to come down. Well, at least that's our view. Anything else to add to that, JP?
Yeah, I just want to emphasize that move in bond yields between October and December, as you've just said, Eugene. I mean, I'm an old-fashioned bond guy, as you know. I started in London in 1984 and actually was managing global bond portfolios in 1984. We saw the 10-year note yield. You got it to the button, actually. It literally touched intraday 5% on the 10-year US Treasury note yield. And then it dropped down. I think it traded at 3.87. And that's a 113 basis point move in a relatively short period of time. Now, as you know, obviously, everyone listening knows that the longer the duration of your bond, the greater the sensitivity to any given change in terms of the basis point change in yield. So just for very round numbers, if you've got a longer dated bond with a very long modified duration of 10, if you get 100%, 100 basis point decline, it's a 10% rise in price. So you saw a dramatic increase in prices at the longer end of bond markets around the world. It was a really quite a startling move in global bond markets. So the team did very well, actually, basically taking advantage. It's almost like a gift you couldn't ignore at year end with such a sharp decline in yields, sharp rise in bond prices.